Welcome to another AriasWave update. Okay, where do we start? How about we start with shit's about to hit the fan, right? Now, I don't say it lightly. This is an AriasWave market update, so I'm going to tell you what I believe the markets are doing at this point in time, and I don't really care about what anybody has to say. The waves are talking to me. So, unless you're on TradingView, then basically certain people I won't see their comments anyway, and others will be turned off. So anyway, the point that I want to state here first and foremost is the long-term pattern of the Dow Jones. I think it has a lot to do with what we're about to see very soon. So I have been known to be wrong when calling tops and bottoms and what have you, whatever. But been really doing some research on this one, and what I believe this pattern is a D wave since the Great Depression. That's basically like a zigzag that's been stretched out to the magnitude of orders of magnitude larger than what it should have been. But that's just an assumption, right? Because patterns create the markets only create two patterns, as I've explained to you previously. Markets only create two patterns, and these are the two patterns, right? Now you can have the bearish version and the bullish version of both of these patterns, but essentially it's the same thing. It's a zigzag or a five-wave move. Okay, so let's take this a step back and let's talk about let's talk about what this pattern is. So what this pattern means is that long term, we're looking at a zigzag that's been stretched out like crazy, right? So to identify each one of these patterns, as I have done here, there is a particular method that I've used, which is AriasWave. And I do have data that goes back further than this. In fact, it goes back to around 1400. But I have enough information here, and AriasWave gives you enough knowledge of the waves so that you can piece, put the pieces together to try and understand exactly why um, a market is performing a particular move. And if you don't have the historical data, well, you're in trouble, right? So that aside, we had the first move up, which was right after the Great Depression. It was basically like a very extreme elastic slingshot back from being so taken so far down below what would have been considered at that time the medium. It had like a slingshot effect on the markets. Now, this can be due to many causes, but from what I understand, it happened because the Fed reduced the money supply by a third, at least, and there's more to it than that. But I'm not going to get into so much of the macro side at this point, although that is coming as I have a bit more knowledge on the macro side now. Not so much on the social side. That's something that happens separately. So after you had that move, you had an A, B, C, right? Now, where's the D wave? Well, that's the one that got expanded all the way up here, and that's why you had the GFC, right? The GFC was merely a reaction to an expanded D wave, right? So basically, what I'm trying to say is, if the D wave would have just happened as per normal after the C wave here, we would have seen a small D wave, an E, and then we would have had our D wave completed, uh, something like that. But even that seems a bit small. Some may even argue that this whole thing here is a D wave, but that just looks silly to me. It's not possible. So this is why a lot of people got it wrong. Aliaticians got it wrong. A lot of people have it wrong at the moment, especially if you think this is going to keep going higher. So this is obviously going to be recorded into a platform like TradingView where you can't delete the video. So obviously, what I'm saying now will stick for life to AriasWave. And I know this. This is why I'm doing this confidently, and it takes some balls. So anyway, So the problem with this pattern is that you need a set of corrective patterns to happen within each pattern. Okay, and there's variances. But in this particular case, we're going to talk about the D wave that happened in between, right? So in between this move here and this move there, so between basically 1947 and 2008, right, 2007, we had a zigzag. So within the whole pattern is another zigzag. So it's like a zigzag within a zigzag, which was expanded because within a zigzag, you have that whole corrective pattern, the whole set of corrective waves, right? So if you understand what RS wave is, you'll understand all the different reasons why this is true. Anyway, so this explains a lot about why we've seen five wave declines throughout history, especially after 1987. Well, in particular, let's talk about anything that's a five wave move to the downside. So we had the C wave here in, the 70s. That was a five wave move. 87 crash was a five wave move. GFC was a five wave move. The Corona crash was a five wave move, but that was only part of a five wave move correction. So it was part of the corrective part of wave four because every correction has these same patterns. Okay, so but the thing is that wasn't the real correction, and that's what I thought it was initially. That's where I got it wrong, and so I'm coming back again to correct my mistake on the waves. Because, mind you, I've had my bullish views, my bearish views, and there's a reason for it. I started off bearish, and then I went bullish, but then realized that I should be bearish, and this is why. So this pattern so this is actually going to complete the C wave of the larger D wave, which is a large, long-term, larger pattern. So we're no longer talking about corrections that are going on within the D wave. We're talking about corrections going on within the larger, long-term pattern that you can't see on this chart, right? And it's very hard to get that kind of data, but there is a way that you can get it using. And there's this chart where somebody connected the European chart to the US chart at a certain point, and you could see quite clearly what's going on. Anyway, so my point here being is that every successive correction has gotten, you could say, more extreme depending on how you look at it. But definitely the GFC was the biggest. But what we're going to see now is going to be even bigger than that. So it's going to be the another E wave, right? Another E wave, but this E wave is going to be larger. Now, may it come back to retest this long-term uptrend pattern? Now, as I said to you before, D wave is a breakout wave. So being a breakout wave, it'll probably come back to retest the area that it broke out from. Okay, so that makes more sense to me than just saying we're going to get a correction that comes back to retest this trend line. Well, that's probably not going to happen because we're no longer within the D wave pattern after we complete the D wave pattern. Now we're just dealing with the overall pattern, right? And that's why the Great Depression was so big, was because it was its own pattern in the greater scheme of things, right? So after we get this big move down, we're going to see another rally higher, which will probably be more impulsive than anything we've ever seen. Actually, we have seen, oh no, well, actually, if you go back to the 1500s, around that area, you can see that kind of pattern. But yeah, anyway, you need to be able to see that chart in order to understand what I'm talking about. So basically, what I'm trying to say is that there's something coming to a head here, and it's not just this pattern. Okay, now I have mentioned to you the TNX pattern, the 10-year bond yield pattern. Right now, you can see what is going on here. We are seeing a reversal, and 2020 was definitely a reversal for a lot of different charts, in my opinion. Not necessarily the stock market, but apparently the stock market is the tail. When you're talking about the dog, the head is the credit market, right? So this is the head of everything that's going on. Now, interestingly enough, just for a fun fact, this pattern is a B wave that started in 1440. Interestingly enough, also, which is probably non-related, but I still want to add it here because it's fun. It's a fun fact. There was a partial solar eclipse in 1440 was the last one, and we saw one basically like very, very short time ago. I think it was a week ago or somewhere along those lines. Um, and I just find it so intriguing how the timing of these sort of things happen. To me, it's just intriguing, like you wouldn't believe. Obviously, I love the waves. Anyway, the point here is that we have seen in my opinion, a bottom in the bond yields, which means we're going to see some tail risk eventually, but this is where it all starts. Now, what is expected after this pattern is a large five-wave move to the upside. So, given that we've had such a choppy move down since 81, and the way that this has been suppressed, I believe we're going to get a slingshot effect. So, this is going to coincide with the massive sort of style move down in the stock market that we're going to see soon. This is exactly the reason why I believe it's going to be so bad compared to previous moves, which have just been very basic and not as important as now, especially because of the money supply and the debt levels, etc. Okay. Now, I have also mentioned in my previous ideas gold, but I'll go to gold in a moment. But I really just want to go to Bitcoin for a moment for the sole purpose of illustrating something that also kind of relates to the way that the stock. Okay, so if you think about it, right now, this is my opinion only. You can make your own opinion, up to you, whatever you do. I'm not saying this is completely topped out yet, but I just want to give you like just my thoughts here. So we all know this crypto called Bitcoin, which is the first cryptocurrency, leader of the pack, grandfather of cryptos, basically started around the end or the low, or when the GFC was happening. So whether you like to admit it or not, this has moved along with the Dow Jones. Okay, now I'll take you a minute to reflect on that. Actually, I haven't got a minute. But what I'm trying to say is sentiment socially, waves are driven by sentiment, social sentiment, right? Social mood. So that part, I get it. Totally get it. That's one thing that I enjoy about Robert Prechter's work with AriasWave. Not so much the pattern itself, because I believe that doesn't really have a fundamental basis to reality. But a lot of the social stuff, like his book, Socionomics, very good book. Another book to read is, like I mentioned, the Intermarket Technical Analysis, John J. Murphy. Very good ways to sort of try to capture what's going on, along with learning the waves. Now, if this five-wave move is over and the Dow Jones move is over, where do you think cryptos are going? Right? If the Dow Jones will crash below the GFC levels, where do you think Bitcoin's going to crash down back towards? All right, so I'll leave that with you. I'm not going to really speculate too much on that. Now, I do have some ideas, but it depends. It depends a lot, and I'll tell you why. So, after this pattern that we've seen up in the Dow Jones, which is a five-wave move since the GFC, you should expect a five-wave move to the downside. So that's five up, five down. Okay. It's not often that you see five up, five down. Usually it's five down, five up. Although that's definitely arguable because the end of certain patterns happen after a five-wave move. But that's fine. That's not my point here. My point here is that we're going to see a large five-wave move after what appears to be a large five-wave move here. So which is going to be stronger? Is it going to be the five-wave move that went up in Bitcoin or the five-wave move that's coming down in Bitcoin? Okay. And that's the thing that I'm trying to get you to sort of think about here, right? Which one's going to be bigger? Now, I know what's happening, or I assume I can theorize and assume what's going to happen on the Dow Jones, but cryptos, well, I would say there's going to be some issues there. Okay. Now, it's a gamble. It's a complete gamble from a wave perspective to assume that it's going to be nothing. Okay, that's all I'm saying, right? I don't want to say any more than that because I know a lot of people are crazy about cryptos, and it's the mania that's making me think that this is even more credible at this time. Okay, And not to say that cryptos aren't going to make a comeback, but who doesn't want to buy cryptos at rock bottom basement prices, right? So at the end of the day, it's up to you how you want to take it. If you're too invested, obviously you should lighten up the load. If you're not even in cryptos, you should probably be very patient and maybe subscribe to the channel and see how we can track this, so we can get an understanding of how the whole thing is tracking at the same time, right? I mean, if the Dow Jones starts to slow down and make a low, then obviously cryptos aren't going to fall any lower. So we're not going to just use one chart to try and gauge this. We're going to be using a whole bunch of charts to try and gauge what's coming. Okay. Now, the other chart I want to talk about again, which I have already mentioned to you, and if you haven't seen the last video, I mean, it's basically right here. It's we're looking for a massive move up in gold. Now, why is it that gold is about to smash higher? Okay, so this is interesting because there's one more chart that we need to touch on, and that's obviously the US dollar, but we'll probably check out the euro. And I've talked about this already in the previous gold idea, but or whichever idea I posted it on. But I thought I'd just make a market update this time because I haven't done one of those for a while. But I'm pretty sure I'm going to be posting a lot more of these a lot more often to definitely be tracking what we're seeing now. So we're looking at a massive move up in gold, right? So I'm not too happy with any other investment at this point in time other than gold. And mind you, I am not a gold bug. In fact, I have been more bullish on cryptos recently than anything else. I was even bullish on the Dow Jones, but now that I'm starting to see the patterns, the way that I see them, and join the dots, and I'm also doing my proper analysis. It's not just regarding the waves. I'm starting to see that gold is probably the best store of value at this point in time because of the pattern, right? And also because we're going to see a lot of inflation. Inflation will accelerate if bond yields start to shoot up. I can see inflation accelerating at a rapid pace. If you want to look at it from a wave perspective, we can see that wave E was very well, it's an ending diagonal for those Elioticians out there, but I don't call it that, right? I call it a type 1 weak wave E. Okay, now you can see in my last idea, I started to say, look, this thing's, well, actually, probably a couple ideas ago, I gave you a long trade idea. And if you would have taken it, you would have made a bit of profit, but then it came back down and you might have sold it because you got scared, like a wave knowledge. But in this particular case, there's a few reasons why you should hold on to this because I think this thing's about to go parabolic. Okay, and the reason being is because this pattern is complete, plus we've seen a truncated fifth wave, and that is rare. I never even used to believe that truncations existed until I saw this chart, right? So I'm very skeptical of anything that AriasWave has to show. But seeing that I saw this for the first time and then the subsequent moves proved me wrong, and I started to definitely put on the bullish view, I started to see something that I've never seen before: truncation, right? So truncation means that the fifth wave, which is always supposed to make the final low or the final high, depending which way you're pointing towards, never happened. And it blew me away. Okay, it blew me away to the point I'm like, oh my God, this is real. Okay, at least they got one thing right. Now, you cannot put a target on this trade, by the way. This is definitely going to be interesting to watch, and we have to use the waves to our advantage. But what you're starting to see here is a reversal pattern if you use candles. Uh, at this point in time, no point using the weekly, but I dare say that by the end of this, if you use the weekly chart, we're going to get some, what's that called, piercing pattern on the candles. But really, it's not so much a piercing pattern because it's not happening right at the bottom of a downtrend. If you like Steve Nissen, very good uh, info on candles there. But using the waves in general, to me, like I've mentioned before, if you go down to the 4 hour, this is going to basically start going back up because the waves say this was the end of wave 2. This is the low. Sorry, I removed my special colors, just doing my own thing. So I'll put them back for a moment. Right, that's the stop there. Anyway, 1758 the stop. Look, please stay updated, subscribe. I'm making sure these videos are going to YouTube now so we can get more viewers. I'll catch you in the next one.